Number 6 is you ignore your costs. There are 2 types of costs that will absolutely destroy how much wealth that you will build. Number 1 are fees, number 2 are taxes. Let me start by talking about fees, because if you invest your money into the stock market through funds, there are some funds that are going to charge you higher fees than others. So I want to analyze 2 different types of fees. One is 0.07% fee and one is a 0.85% fee, which might not look like big fees or even that much of a difference, but it can make a big difference in how much wealth you're going to build. So if you're investing your money into things like index funds or mutual funds or ETFs, if you have a 401k, if you have an IRA, I want you to take a look at this fee. It's called an expense ratio in all of these funds, and it's something that I want you to consider. So let's take a look at these examples. Investing $1,000 a month for the next 40 years, where you're going to get a 10% return on your money. If you have to pay a 0.07% expense ratio, that means after paying your fees, you're going to be left with around $5.2 million in your investment account. But if now instead of paying 0.07%, you're paying 0.85% with everything else staying the same, well, now you're not going to pay $10,000 in fees or $100,000 in fees or $500,000 in fees or $750,000 in fees. You're going to be paying about $1 million in additional fees, because now you're going to be left with $4.2 million, because that $1 million difference went into your money manager's pocket. So what you want to be thinking about now is, if you're paying higher fees, is it worth it? Are you getting higher potential returns to justify paying the higher fees? Because these higher fees can end up costing you a lot of money in the long term, and it doesn't take you that much work to switch it if you feel like you're going to keep more money in your pocket, and it can result in tens of thousands to millions of dollars in differences of how much wealth you're going to have. It's the same thing when it comes to taxes, because as an attorney who's not your attorney, what I can tell you is that our tax code has a lot of interesting loopholes, especially for investors. Now, if you're investing your money into the stock market, there are more limited things that you can do. But if you're investing your money into things like real estate, now the options really start to open up, because with real estate, you can buy a property for, say, $500,000. You sell it for $1 million. You think you have $500,000 of taxable income, which it would be that case if it was anything except real estate. But in real estate, you can do what's called a 1031 exchange, which says you take all $1 million. And now if you take the $1 million to go out and buy a bigger property that might be paying you more money every single year, well, now you don't have to pay a penny in taxes today. You can keep deferring this tax bill until you die. And if you do that, you never have to pay the taxes. So understand that taxes are a huge cost, but as an investor, you have the ability to potentially pay less money in taxes, because that's what the tax code says. So get a good tax advisor on your side, because even if you're not investing your money in real estate, if you're investing your money in stocks, you might not qualify for the same types of tax breaks. You still qualify for lower tax rates. And mistake number 7 might be the most expensive for people that make a lot of money. This is, you live off of your equity instead of your income. I'm going to make this a little extreme for the purposes of this example. Let's assume that you invest your money into this thing, and when you do, it's worth $100,000. This could be stocks, it could be a business, it could be real estate, I don't care what it is. You invest your money into this thing, it's worth $100,000, but then the economy starts to boom. You end up finding out that this industry that you're investing in really takes off, and then a few years later, it's now worth $10 million. Now you're rich, at least on paper. Your net worth goes from $100,000 to $10 million because your investment is now worth so much more money. Now what you can do is pull some cash out through a refinance, because every bank is going to say, hey, you have $10 million worth of equity here. You're driving around in a Toyota Corolla. How about you upgrade your lifestyle? How about we give you a 65% loan to value debt? So now you go out and pull out $6.5 million from the bank in the form of debt, because you still got some equity on the table. I mean, you didn't pull out all $10 million. You only pulled out $6.5 million. So you still have a lot of skin in the game, still got a lot of equity. And now you start to live a bigger lifestyle. You go out and start spending this money. You start driving around in better cars. You live in a better home. You go on fancier vacations. You spend this money, but then something bad happens in the economy. Something bad happens to this industry. Something bad happens. And so now this value drops back down to, say, $500,000, which is still 5 times more than what you bought it for. But your income also is not covering all of this. You were living off of this debt game because that's what the banks were allowing for. Now you have many multiples more debt than what the property or this investment is worth. This is what has destroyed so many investors, even the ones that have become multimillionaires. This is the reason why so many investors will then end up bankrupt. It's because you stop living off of the income and you start living on the equity. When you start living off of the equity, this is what makes people go bust. And you don't have to be a sophisticated investor to start doing this. You see the same thing happen when people see their homes go up in value. You bought your home for $300,000, now it's worth $1 million, and you pull out all this cash and you buy a fancy car, you buy a boat, you buy some vacations. Now you have a whole bunch of payments and nothing to show for it. And if the home goes down in value and you can't make the payments, now you get screwed. So if you really want to be a sophisticated and smart and protected investor, not have to run into all those issues, live off of the income, not the equity. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.